The question is, will using a 401k loan to buy a home be the worst financial mistake I can make? Now listen, we just talked about something completely controversial, and that is building wealth using your child support. So let's just get into it. Most people are told that one rule about retirement accounts is never to touch your 401k. That rule was built for two-income households. That rule was built for people with a backup plan, but people with time on their hands. This rule was not for the single mom. Single mothers don't live in that reality. And we want single moms to be wealthy, so that means we're going to have to use strategy because we don't have time. So today we're going to talk about what a 401k loan actually is, how it works, the numbers behind it, and why, for some single mothers, leveraging it strategically, not for all, but for some of you guys, leveraging this strategically can reduce long-term risk instead of increasing it. And it can get you toward financial freedom, but not just financial freedom, but wealth. Before I go any further, I got to go ahead and kick out this disclaimer. This is educational. This is not tax, legal, or financial advice. 401k rules vary by employer plan, so always verify what applies to you. So with that out of the way, so you can't sue me, this is my opinion. You can use it at your own risk. They say, eat the fish and leave the bones. So let's get started. A 401k loan is not a withdrawal. You are not cashing out your retirement. This is money that you are borrowing from your own retirement account under IRS rules. Know the rules, follow the rules, and play the game. The loan is issued by your plan administrator, and it's not a bank. The interest you pay goes back to your own retirement account, not to a lender. And that distinction matters. Under IRS rules, most plans allow participants to borrow the lesser of 50% of their vested balance, or $50,000. So what does that mean to you? That means you can't borrow the entire amount of whatever is in your 401k. It means that if your 401k balance is, let's say, $40,000, then the maximum loan that you can get is $20,000. Simple math, right? However, if the balance is $80,000, the maximum loan is $40,000. You get where I'm going with this? One more time. If the balance in your account is $150,000, the maximum loan that you can get will be capped out at about $50,000. So these limits are set by law and by the plan rules. So let's talk repayment. 401k loans are repaid over about 5 years. Interest rates are typically modest, meaning that they're often around somewhere between the prime plus about 1%. It commonly falls between about 5 and 8% is what you're looking at for, which is basically market right now. So that interest is paid back to you. Some plans allow longer repayment terms when the loan is used for a primary residence. So you need to do some research yourself and find out exactly how it applies to you. But that is in plan specific and it's not guaranteed. 401k requires no credit check. It has no traditional underwriting. It has no prepayment penalties. It provides access to capital without even selling any of your investments. This is a really good opportunity for you. This becomes a way to fund the down payment, the closing costs, or any temporary gap in funding if the lender allows it. When you take a 401k loan, the borrowed amount is temporarily out of the market. That portion does not earn investment returns while it is loaned out. You also repay the loan with after-tax dollars. So there is an opportunity cost there. So you're going to, 6 in one hand and a half dozen in the other is how my mother would put it. So let's talk about the math. If $40,000 stays invested at an 8% annual rate of return for 5 years in your 401k, it grows to about $58,800. So that is roughly $18,800 in growth in your 401k plan, which of course we've been talking about building wealth, and that is what we want to see, that type of return. However, when that money is loaned out, you miss that growth in your 401k. That interest you pay back to yourself over the period of about 5 years with returns of approximately $6,000 to $7,000 to your retirement account. So the net opportunity cost over 5 years is closer to about $12,000, not 18, because you're going to lose, of course, a little bit because your money is not invested during that time. Now, to compare that to the asset being created, what we're talking about when we say the asset that is being created, we are talking about the appreciation on your home, the appreciation on your property that you're purchasing. If that same $40,000 that you pulled out of your 401k is now invested in the purchase of a $300,000 home, which is the average price of a home in Charlotte, and that home appreciates at 3% annually, the property gains roughly are going to be about $47,800 in value over about a 5-year period. Add the principal down payment that you made to the $40,000, that's about $87,000 in home equity created. So with your down payment and your appreciation, you have created about $87,000 in home equity. Now, if you buy a house that already has equity when you purchase it, that's even more, right? That's you doing it, right? So the math looks like this. A temporary retirement shortfall of about $12,000 in exchange for approximately $87,000 in home ownership equity. That's what we're talking about when we're talking about building wealth. So now you've shifted wealth from your 401k and you've tripled it in the equity and the value of your property. That is a net shift in net worth. Assuming the strategy that I'm giving you is executed correctly. So if it don't work out for you, don't call me. Let's be clear about the risk. This is a very great strategy, but let's talk about the risk. A 401k loan becomes a problem. Taking a loan out in your 401k becomes a problem. When you leave your job and don't repay the balance, you stop contributing entirely. You borrow too much money, or you treat the loan like it's free money. That's when it becomes a problem for you. Because if you leave your employer and don't repay the loan, that balance becomes taxable as ordinary income and may be subject to a 10% penalty if you're under the age of 59 and a half. Now, if you're over 59 and a half, you got small kids, you got 18, years of, funds growing in your 401k, then you're good to go. But if not, those are the facts. So this does put you behind. But here's the shift. The shift happens. Here's the change. I'm going to say change because shift sounds kind of funny. Where compounding happens. Instead of all of that compounding inside of your retirement plan, some of it happens through home equity and housing stability. Because what we're talking about is building wealth. We're not talking about just putting cash in our 401k now. Now we're talking about wealth strategies. How you go from being a single mama to a millionaire. So here's the controversial truth for single mothers. Missing 5 years of compounding interest on $40,000 might cost you around $12,000 net. So it might cost you about $12,000 to not keep the money in your 401k, because a lot of people are going to be like, but Tiara, if I take the money out of my 401k, I'm losing money. Yes, you might lose. Based on the math that I'm giving you right now, you may lose about $12,000. But missing 10 years of home equity growth because you continued renting can cost you 6 figures. That's not emotion, that's math. This is why this strategy is not to use your 401k to buy a house. This strategy is called sequencing. It's build retirement first, borrow it conservatively, buy intentionally, and keep the compounding alive. Once your portfolio is working, home ownership becomes an option. Not through sacrifice, but through strategy. This is strategy. It includes using your 401k where you can. And I break all of this down more deeply in the $800 strategy available February 26th in my book. So if you like the content I'm sharing with you here, please like, share, subscribe, comment, do all of the things. All right. That is the information I have to share with you for today. And thank you so much for hanging out with me. I truly enjoy doing this. And if you like hearing what I'm sharing, please let me know in the comments.